Hello and welcome to Chapter 20. In Chapter 20, we're going to take a little bit of a detour from what we've been doing, and we're going to look at cost in a little different way. We're going to look at cost, we're going to break it down between variable and fixed cost. And what we're going to try and do is evaluate new businesses or business opportunities based off of something called cost volume profit analysis. And we're going to focus in on looking at cost in two different ways: fixed cost and variable cost, actually three: fixed cost, variable cost, and mixed cost. And we're going to look at those relative to selling price, and we're going to learn how to calculate break even and some of those types of concepts in this particular chapter. Um, and um, and so their first learning objective is we're going to talk about, really it says here, determine how cost changes, how changes in volume affect cost. Well, what we're really talking about here is a couple of different types of costs. The same thing I touched on earlier: fixed cost, variable cost, and mixed cost. So let's take a look at each one of those independently. And here they are: variable cost, fixed cost, and mixed costs. Obviously, variable costs vary with the number of units. Fixed cost remains constant, and mixed costs are a combination of the two. Let's touch on each one of these just a little bit. Variable costs change based off of the number of units produced. If you look at this particular table, it shows that if you have 0 tablets produced, and your variable cost, and if you might think about this from a product cost perspective, that might be direct labor or direct materials. But if you produce 0, your total variable cost is 0. If you produce 25, your variable cost is 25 tablets times 55, or the variable cost per tablet, and so on. So as the volume changes, the cost per unit remains constant. So no matter what happens, your cost per unit remains the same. And you notice here, it's basically a straight line from 0 to 100 in this particular example. And it tells you what your total costs are from variable, and the line is straight. Now if you look at fixed costs, that's a little bit different. Even though it doesn't show it here, fixed costs really remain constant no matter what range of values you have. So think of it this way: if you're starting a new business and you have to pay for the property taxes and insurance and the rent for your building, and maybe you're also paying a supervisor to run that building before you've made one sale, those costs are probably all going to be fixed. They will not change, okay? They will not change no matter what the level of activity. You might not even open your doors, but you're going to have a fixed cost, and it's going to remain constant no matter the number of units that you produce. So what happens though is fixed costs change based off of the number of units you produce on a per unit basis. So you notice, if you remember from our variable cost example, our cost per unit was $55 fixed no matter what, and as we produced the number of tablets, it changed. But you notice here, what happens is we have fixed cost, and if we produce the number of tablets, the higher the number, the lower the fixed cost is on a per tablet basis. So that's the difference between the two, okay? And if we look a little bit more, and here's just another way to look at it. You can review this slide from your book. It says total cost changes proportionately to changes in volume. So as volume increases, the total cost increases. And as volume decreases, the total cost decreases. And fixed costs remain constant no matter what, and it's inverse with the volume. Now mixed cost is a little bit different. It has a variable and a fixed component. So notice on here it says minutes. I might say not minutes, but maybe gigabytes. So think about your cell phone for a minute. If you're on a certain plan with your cell phone, with your phone, you pay a flat amount of money. You do, or your parents do. And when you pay that amount of money, so long as you stay within your plan, it's a fixed cost. But once you've stepped over the threshold of whatever the gigabytes or whatever the plan is, it now becomes a mixed cost. So you have a combination of the fixed cost for the original bill, and then the variable cost depending upon how much usage you have to figure out what your total cost is. That would be a mixed cost. We're going to focus predominantly in this particular chapter on fixed and variable cost, but you also need to realize that there's mixed cost. In industry, generally speaking, all costs are mixed cost with very few exceptions, okay? And you can see what it looks like, a total cost equation. And there's the mixed cost, a fixed component, a variable component. This is a graph of how mixed costs work: a portion of fixed and a portion of variable. Now we can look at something called the high-low method to calculate a total cost equation. And what we're going to do is we're going to take the highest volume activity less the lowest volume activity, and if highest for dollars and units, and we're going to do a division. So let's take a look at how this works. So we're going to take the high level of activity, dollars, divided by the low level activity, and the high level of tablets divided by the low level of tablets, and it says $2 per tablet. And if you think about it, when you see something that says per tablet or per unit, that generally is going to tell you that it's a variable cost. So we're identifying the variable cost per unit here. But now what we're going to do is we're actually going to go back and put that into an equation to calculate our total cost. So what we have here is we have total mixed cost or total cost, and what we're going to do is we're going to say here's our total cost, which we know is $19.60, less the variable cost, which is $2 times 480. And what's going to happen here is when you do the math and we pick the high, so we take 1960 less 960 says that our fixed cost is $1,000. And what we're really doing is we're using those 2 points to generate a line, 2 data points for a line on that graph. So if we take a look now, we'll calculate what our total mixed cost is, and I prefer to call this total cost. It's $2 per tablet times the number of tablets times the $1,000 in fixed cost. So if your tablets are 100, this will be 200, and that's going to be 1,200. And you can go back and take a look at that relative to the equation that we looked at earlier. There's you might refer to your text. There's a little bit more detail for this particular information about how to close the loop on that. The relevant range is where costs remain constant. So from 0 to 2,000, the cost and variable costs remain constant. And here's the relevant range, and it's really between a range of like 40 to 80% of capacity. And if you go above that, you have what are called step costs. And if you have costs below that, they're also called step costs. And what I mean by step costs is as things go up, as things happen, you have differences. Think about it this way. If you worked in a factory and you were working, say, one shift, and you decided to put a second shift on, or start a second shift, you'd have to have a second shift supervisor. So all of your costs would step up once you're outside of the relevant range, and vice versa. If you cut your production, maybe you have less supervisors that you need to have, therefore your cost would go down. Okay? So let's take a look at operating income. We're going to use something called a contribution margin. And in a contribution margin, doesn't really say it here, but what a contribution margin is it's your selling price less variable cost is contribution margin. And what we're going to do is we're going to change the way our income statement looks. And where before in a traditional income statement we had product cost and period cost, well, now what we're going to do is we're going to take those product costs and period costs and break them down to between fixed and variable cost. So we're only going to look at variable costs, irrespective of whether it's at what we used to call SG&A, which would be period cost, and product cost. What we're going to do is we're going to put all those in as variable costs, and we're going to compare that to the fixed cost, which breaks it down between those two. So it's a little different type of income statement. And this is for internal use, not external use. So what we have is, and you can see this here, contribution margin, we touched on it, is sales less variable cost. So if we sold 500 units, $5 per, if we sold 200 tablets at $500, our sales were $100,000, and our variable cost was $275, which was per tablet times 200 units, that is 200 tablets. So it says that our variable costs are $55, so our contribution margin is $45,000. Notice no fixed cost here. Okay? And if we look at it on a per unit basis, our contribution margin per unit is $2.25. It's the selling price less the variable cost per tablet gives us $2.25. And we can also look at it a contribution margin percentage or ratio. And so it says that our contribution margin is, you can do it in both ways, pure dollars, 45,000 divided by 100,000 gets you 45%, or 225 divided by 500 gets you 45%. That tells you really, that says for each dollar in sales you have, you are generating 45 cents contribution margin that you will use to cover your fixed costs. and here's what you have. And here's the traditional income statement on the left side. Cost of goods sold, selling and general administrative. So this is product cost, period cost. And then your operating income. But now what we're doing is we have net sales, but we have variable cost, which has product and period costs in it. And we come up to contribution margin. Less the fixed cost gives you operating income. So that's the difference. And we're focusing clearly on this side of the equation, not on this side or this side of this particular slide. And we're going to use this for profit planning. You say, why is that important? Why is it important for profit planning? Well, if you are going to start a business, you want to know, for example, how many units you need to sell to break even. Let's say you're going to start a local donut shop and you want to know how many dozen donuts you need to sell in a day in order to break even. Why does that matter? It matters because it's going to determine whether or not you even think you can sell the donut shop, or you can even start the donut shop, because you have to look at your cost structure and you have to look at what is break even at a minimum. And of course, we want to make a profit. So break even is the minimum of what you want, but you want to make a profit. So it's really important for us to take a look at that. And we're going to do something called cost volume profit analysis. And we're going to use a formula that kind of looks similar to what we just saw. But what we're going to do is we're going to take a look at the relationships between cost and volume and how they affect profits or losses. And you see here we have price per unit does not change as volume changes. So in the assumptions here, price doesn't change, and you can affect the cost, variable cost or mixed cost. And the only thing that changes is volume changes, and fixed costs don't change, and there are no changes in inventory levels. Those are all big time assumptions. But let's take a look. It tells you how much sales you need to do to also achieve not only break even, but a targeted profit. And there's three different ways you can look at it. You can look at it with an equation, a contribution margin, or a contribution margin ratio. And we looked at some of these already, but let's take a look at them again. Here's the equation approach. And they all have the same characteristics. If you guys did, this is just some basic math. And this looks like, one equation you can look at. It says net sales less variable cost less fixed cost is equal to operating income. So this is one equation. I kind of like to look at it with this in this equation. If operating income is set to 0, that would be a break even. Another way to look at this is put an equal sign here, right over here, where net sales revenue is equal to variable cost plus fixed cost, would be another way to look at it, and that's the break even formula. So let's look at our deal here, right? This says we're taking the selling price times the number of units, less the variable cost times the number of units sold, less the fixed cost, and that tells us a targeted profit of 80. So what they did is they said, well, we want to make $80,000 or $6,000 over this time period. So they put that as the targeted profit, as operating income. And so if you look at this equation, it says, okay, how many units do they need to sell? This is just basic math. It says that they need to sell 80 units. If you go to the next one, we use something called the contribution margin. And you can tell, and this is contribution margin, and this is a per unit contribution margin. So we're going to take fixed cost plus targeted profit divided by contribution margin. Tells us how many sales in units we need to sell in order to make our targeted profit. And of course, if you wanted to figure out what your break even is, you make this targeted profit number 0. And then this one's the ratio. It's the same kind of deal. And then we missed the other slide, but there should be another slide that talks about the number of units. But this one also tells you what your required sales dollars are. And if you want to know the number of units, you're going to have to take the $40,000 divided by the $500 and tell you that it's going to be 80 units. And then you have a break-even point is where, and we talked about this, is where sales is equal to total cost. And now here's another example of that. And I'm not going to go through this. We've touched on this already a little bit. Your targeted profit here is 0, which means that it's break-even. The targeted profit here is 0. And you notice you have the 3 different approaches, and it tells you the same thing. And you notice this one down here is rounded a little bit. And you can see this is a graphical thing. No, I'm not an economist, but a graphing thing here says, look, at this particular point is break even. When you get here and above, this means that your revenue, the blue line, is greater than your total cost. Remember, your total cost is a combination of fixed cost, this line, plus the variable cost, which starts here. So as the units increase, your cost changes, but as your units increase, so do your sales. So this is just kind of a cost volume profit graph analysis. And if we look at it from a sensitivity perspective, they can look to see what if scenarios. And it's kind of cool in a way, because if you're running a business, what you can do is you can take a look at what would happen if you sold more or less. And that's what we're going to take a look at here. So let's say the company said, well, we want to change our selling price from 500 to 475. What does that do? How does that change our break even? Well, it changes our break even from 54 to 60. So that means they have to sell 60 more units in order to achieve break even if they change their selling price. And if you have a change in variable cost, you're basically manipulating these formulas. So long as you start with the base formula, the rest becomes very straightforward. And in this particular example, they used the contribution margin approach. You could just as easily use the formula approach, or you could use the contribution margin percentage approach. Each one gets you to the same place. And for changes in fixed cost, same thing. Or if you have changes in targeted profit. So either one of these two are just pure dollars, and if you change those, you can determine what happens to your break even, or what happens, how much sales you need to have in order to get that. And they put 0 for these because they want to look at break even, but you could just as easily look at it based off of targeted profits. And I'm not going to read through this because this is kind of a challenge for this particular slide. And some of this I think is easier to run with numbers as opposed to read the concepts. But you can kind of get an idea of some of the basic rules of thumb. If you understand the basic concepts, you know what happens. So I'm not going to spend time here. Now we're going to look at something called margin of safety, as well as operating leverage, and what we want to look at for multiple products. So margin of safety is really how much sales can go down and where you can still achieve your targets or break even. Operating leverage is the ratio of fixed and variable cost. And multiple product break even has to do with what's your profitability with product mix, because a lot of companies don't just have one product. So let's look at this and we'll look at each one of these we touched on already. Okay, margin of safety, notice here it says, is the excess of expected sales over break-even sales. And you can take a look how this is calculated. I'm not going to go through all this, but basically you're saying we expect to sell 100 tablets, and our break-even is 54, so our margin of safety in units is 46 tablets, and we multiply that times 500 tablets, and it says $23,000. And it's telling us that sales can go down by 46 tablets or $23,000, and we'll still break even, and our margin of safety ratio is 46%. So it says that our sales can go down by 46%, and we would still achieve break even. If you're working with a banker, they would want to know this, because if you're trying to borrow money from a bank, their main concern is they want to know if you're going to be able to pay them back. Operating leverage is the ratio of fixed and variable cost in a business. The greater the fixed cost, the greater potential for upside in a business. In other words, that static line that we saw. But the lower the fixed cost, the lower the upside from a profitability perspective. So the greater the fixed cost, the higher the risk, but also the higher the potential return. And that's a very simple concept that you might learn in your corporate finance classes. The less the fixed cost, the less the less upside there is for profitability, and the greater the less risk. So it's a double-edged sword is what I'm trying to tell you. So if you look at this, if we calculate two different companies and we look at the degree of operating leverage, we look at the contribution margin divided by the operating income, which is really a function of the sales. It says that company A has $10,000 in contribution margin, which tells you that they have a high variable cost. So their contribution margin, degree of operating leverage, is 2.5. And in company B, it's 5,000, so it's 1.25, the same income, but it also tells you that they have much higher fixed costs for company B. So if you notice here, the change in sales will result in a much higher income for company B than it will for company A. And there's not a numbers here, but I would encourage you to take a look at that in your text. Sales mix or product mix is the last thing we're going to talk about. And sales mix and product mix has to do with ratio of contribution margin for each individual product. And we're going to look at those on a ratio basis. So we're going to come up with something called a weighted average contribution margin ratio. And so we're going to do that based off of this weights. And it tells us that we have the contribution margin in units, and then we're going to divide them, and this comes up with your weighted average contribution margin ratio. And you use that weighted average contribution margin ratio to calculate your variable your profitability. That's it for chapter 20. I hope things are going well for you this semester, and if you need anything, by all means, drop me an email, and I will do what I can to help you. Have a great day. Thanks.